In this opportunity, we are going to talk about the practical application of WACC as a discount rate for firm valuation. The original WACC formula, originally developed by Miller and Modigliani, is the one usually employed by practitioners to determine the discount rate when doing evaluation for a firm. The common practice is to use the capital asset pricing model, CAPM, to determine the discount rate on equity, RE, and to determine the cost of debt, RD, just using the market cost of debt, how much we are paying for the debt in the market. In this video, we are going to discuss the implication of this practice. First, recall the two versions of the WACC formula that we explained in a previous video. We have a right-hand version and left-hand version. The right-hand version is the one we are familiar with, that shows the WACC is computed just as the ratio of E over V, capitalization ratio of the firm, multiplied by RE, the return on equity, plus the debt ratio, D over V, multiplied by 1 minus TC, TC is the corporate tax rate, and multiplied by RD, which is the cost of debt. That is the well-known version of the WACC formula. The other version that we explained in a previous occasion is this one on the left side. WACC is determined as 1 minus D over V multiplied by TC, and all of this is multiplied by rho, where rho is the unlevered discount rate of the firm, meaning the discount rate that we would apply to the projected free cash flows, assuming that the company does not have any debt. The WACC formula is usually employed in conjunction with the capital asset pricing model. If we use the capital asset pricing model together with the WACC formula, then, in theory, we should compute all the discount rates related to WACC using the capital asset pricing model. We should compute RD, the discount rate on debt, RE, the discount rate on equity, and rho, all of them using the CAPM. And if we do that, we are implicitly assuming that all these rates reflect only non-diversifiable or systematic risk, because as we all know, the capital asset pricing model only accounts for systematic risk in the discount rate. Having said this, let's define the formal WACC. Formal WACC is the version of the model that computes all the discount rates using the capital asset pricing model. It can be shown that starting from the WACC formula, we can obtain this expression for the discount rate on equity. This formula just comes from the WACC formula. It's just another version of the WACC formula. And according to this expression, we see that the discount rate on equity is equal to rho plus D over E multiplied by rho minus RD multiplied by 1 minus TC. We know that rho is invariable. Rho depends on the type of company we are dealing with. Remember that rho is the discount rate on the unlevered free cash flows. So rho only depends on the nature of the company, the risk of the company we are dealing with. So rho is unchangeable. It depends on just on the type of company we are dealing with. So if rho is invariable, once we compute RE using the capital asset pricing model, then for a given level of leverage, D over E, we will have only one value for RD. So we see that RE and RD are not independent variables. Once RE is determined using the CAPM, rho depends on the type of business. Then RD, we only will have one value of RD for every level of debt. So according to the formal WACC, RD and RE are not independent variables. Let's now focus on the practical application of WACC. In practice, RE and RO are generally computed using the capital asset pricing model. However, the discount rate of debt is usually made equal to the market cost of debt. And this has a good reason. There is a good reason for this. It is that practitioners regard the market cost of debt as a convenient way to account for bankruptcy costs. We know that the market cost of debt has a default spread. This default spread somehow measures the bankruptcy risk. So if we use as the market cost of debt the risk-free rate plus this default spread, somehow we are quantifying. This is a way to quantify bankruptcy costs into the discount rate. And once we do this, of course, we are affecting WACC, and then if we affect WACC, we affect the value of the firm when discounting at this WACC rate. So when we use the market cost of debt in the WACC formula, in this way, through the discount rate, we are accounting for the bankruptcy costs. However, we must remember that bankruptcy costs are actually a cash flow effect. Okay, bankruptcy costs, in theory, should not affect the discount rate because bankruptcy costs affect actually the expected cash flow. But in practice, practitioners just do it this in the other way. They just include bankruptcy costs in the discount rate. Well, there is an important implication from this practice. And the implication is that if we do it the way practitioners do it, RE and RD are not dependent from each other, as we saw in the formula that we explained before. RD and RE are independent from each other. So let's define the practical WACC. The practical WACC is the version of the model that computes RE and RD independently. RE comes from the capital asset pricing model, and RD equals the market cost of debt. And they are independent variables, as opposed to what happened in the formal WACC. If we want to understand the practical WACC in a graphical way, we see that first we might imagine a curve reflecting the formal WACC. We know that as we increase the level of leverage, the value of WACC from the formal WACC formula goes down and the value of the firm increases. But as soon as we start to affect the WACC rate by including the default spread, there is a countervailing force bringing up the discount rate WACC, because the more indebted the firm is, the higher the default spread and the higher WACC will be. And then in the end, when we use the practical WACC, we will no longer have the WACC going down with the level of debt all the time. But the new WACC formula, the new WACC curve, will have like a U shape. And in principle, there will be a point at which we will have optimal leverage, the point at which WACC will have a minimum value. Let's focus now on the practical WACC formula. Let's define RDM as the market cost of debt, SP as the default spread. Let's assume for a moment that the beta of the debt is 0. So the systematic risk of the debt is 0. And the market cost of debt is equal to the risk-free rate, RF, plus the default spread, which is the way it is usually done. Then it can be shown that this version of the WACC formula, which is precisely the version that practitioners use, in which we have that the market cost of debt is equal to RF plus the default spread, this version of the formula implicitly assumes that beta of the debt is 0, that the systematic risk of the debt is 0. Something most practitioners are not aware of when they use this version of the WACC formula. So we conclude that the beta of the debt is assumed 0 under the practical WACC formula. But what happens then when the beta of the debt is not 0? Imagine that the beta of the debt is positive. We have some systematic risk for the debt. So in this case, then, we will never know to what extent the default spread includes this systematic risk. So let's conclude. The practical WACC formula is the one commonly used by analysts. This formula assumes that the systematic risk of debt is zero, something that practitioners are usually not aware of. But whenever the beta of the debt is not zero, is larger than zero, then the question is to what extent the default spread is including the systematic cost of the debt. And this is the main problem of using the practical WACC formula. And this is all I wanted to share with you in this opportunity.